Hello, it's Friday the 10th of February. I'm Emily Clark, Partner and Head of Asset Management at Travers Smith. Welcome to issue 51 of Travers Smith's Alternative Insights. This week, we're looking forward to the key themes for 2023, following an event we held in London on Wednesday evening and the launch of our new annual Insights publication, which you can access on our website. So as I said, earlier this week, we launched our annual publication, Insights 23, at an event in London. It was an opportunity to look ahead to what the rest of the year holds for alternative asset managers, and we identified three dominant themes: GP-led liquidity, the retailization of private markets, and sustainability and greenwashing. Everyone knows that 2023 will probably be a tough year for the asset management industry. Fundraising will be harder, and the costs of business to continue to climb. But we found reasons to be cheerful. Each of our three themes offers opportunity for firms that are in a position to take advantage. First, the broad acceptance in the market that GP-led restructurings are often a sign of strength rather than weakness and can be a win-win solution gives a fund sponsor more options when exit markets are difficult. It also helps increase distributions to limited partners who need liquidity, making it easier for them to commit to new funds. As we discuss in our annual update, GP-led transactions are becoming more complicated in some respects and more straightforward in others. More straightforward because GPs and LPs are now familiar with navigating the potential conflicts that can arise, and they've got a good handle on the tricky US tax issues. We've seen accepted market positions emerge as the starting point in the term sheet. Also more straightforward in that a continuation fund is now often a way to exit a single investment, although it is still frequently used for asset bundles and whole fund portfolios too. But more complicated though, as the market becomes more sophisticated. Traditionally, these transactions have been due diligence light, and that has allowed them to be done relatively quickly. But if a continuation fund is a means of selling a single asset, then why not do the same due diligence as you would do on a share sale, with the same warranties, indemnities, and insurance? And if that's the case, when is the transaction an exit for the management team and when is it not? Well-advised management teams are all over this point and its interaction with the trigger point for carried interest. Impending regulation in the US could also add some further complexity to deals. Although the market's acute focus on conflicts of interest means that SEC rules are unlikely to add much of substance to widely adopted best practices, especially as refreshed ILPA guidelines expected this year should give the LP community further confidence. So our second theme is retailization. Constraints on the availability of capital have accelerated the quest by the largest global alternative managers to tap into new sources. Traditionally, alternative asset strategies have been mostly aimed at institutional investors, and this will continue, but wider access is an important development. There is increasing interest from alternative managers in evergreen, semi-liquid funds that are attractive to wealthy and advised individuals, and increased interest from those investors. The regulatory hurdles are significant, perhaps underscored by the FCA's flagship 2023 policy, the Consumer Duty. New rules will, from July 23, require elaborate organisational structures to ensure good outcomes for clients and investors, and UK-regulated firms that are turning their attention to semi-professional investors, mostly high net worth individuals, will be firmly in scope. Although the FCA's new rules will apply to many funds whose investor base is predominantly institutional, the compliance burden will be particularly high for firms deliberately seeking capital from individual investors. And that's been made more acute because the FCA is planning to ditch a £50,000 minimum ticket safe harbour. But other news is more positive. Last month's decision by the UK's Department for Work and Pensions to make changes to the charge cap will help to define contribution pension schemes to include alternatives in their default funds. And in December, the UK Treasury announced a plan to scrap the controversial PRIIPs, Key Investor Document, or KID, which was particularly problematic for private fund strategies. And now we've also got political agreement on ELTIF2, an EU long-term investment fund vehicle offering a retail passport, and uptake will surely further increase. Meanwhile, the UK's version of the ELTIF, the LTAF, an authorised fund vehicle for firms investing in illiquid assets, struggles for attention. However, since its primary audience is defined contribution pension schemes, it may come into its own now that the charge cap reforms have been confirmed. Our third main topic of conversation was sustainability and the related clampdown on greenwashing. In a panel discussion on the Wednesday night event, we shared our viewpoint: be loud and proud about what you do, but be very, very careful. Regulators are constantly repeating their determination to take action against those who overstate their sustainability credentials or fail to follow through on promises made to investors. And we can expect much more regulation of that type in the coming year, from the UK in the form of a specific anti-greenwashing rule, and from the EU, whose proposed regulation of fund names could have far-reaching impacts, and also from the US. Having made new rules, we should expect strenuous enforcement. But sustainability also poses a once-in-a-generation opportunity for fund managers, which is being accelerated by these emerging regulations. Private market firms are very well placed to take advantage of increasing investor appetite for ESG-friendly funds and impact strategies, and many are already doing so. Those that see sustainability as a strategic opportunity and not just a compliance cost will see the benefits in the months and years ahead, especially if it can be used as a differentiator in the crowded market for capital. Insights 23 covers our take on these themes in more detail, but also more technical challenges for the year ahead, forthcoming changes to the EU's AIFMD, reforms to UK limited partnership law, a new and increasingly popular UK holding company regime, and worrying US regulatory changes, among many others. We hope you find it helpful. Thank you for listening. If you would like more information on this topic, please check out our website, where you can also sign up to receive future editions of these insights, or drop me an email, emily.clark@traverssmith.com.